Hi, this is Harry Dent. We just wanted to give an update since our July YouTube video. Obviously, the market top we saw forming back then was not a top. The government has come up with a stronger new policy, which they call quantitative easing. Now, first of all, to understand what this is and how it's different from other policies, the Fed always has two tools for stimulating the economy. The first is the one we normally see. They lower short-term interest rates. They can bring down the Fed funds rates, which brings down all short-term interest rates for bank lending. They took that down to zero, the lowest ever, a desperate move in light of the financial meltdown, of course, along with their stimulus and TARP programs and cash for clunkers and housing credits and everything else. Now, with elections, the Republicans have been ushered back in with the message, hey, we don't want the government stimulating and running up so much debt. So now the Federal Reserve is all that there's left to stimulate, and they're using their second tool. Quantitative easing is when they literally print money out of nothing and buy bonds. So lowering short-term interest rates induces borrowing, but does not actually print money and inject it in the system. When they buy their own bonds, they are injecting money in the system. So it's more potent and it's more dangerous. The first round, the government injected about $1.5 trillion into the economy in the first meltdown. Now they're looking at doing another $600 billion plus reinvesting the proceeds from the bonds that mature. So it's going to be a lot of money going into the markets. Now, if this was being lent, it would help the economy. But we know in this environment, consumer and business demand for loans is low because they're paring down debt after the massive debt run-up in this last decade. So what happens is this money simply goes into speculation. These banks get this money from selling their bonds. The government has pushed short-term and now long-term yields so low, everybody, banks, investors, investment funds have to trade up into stocks, into corporate bonds and junk bonds for higher yields. This is literally just creating another bubble that's going to fail. So this is not a good policy from our point of view. It's best to look at this whole thing since the 90s as three bubbles. We had the tech bubble in the 90s that peaked in early 2000 and then a massive crash in tech stocks, 76%. Then we had the overall stock market and emerging markets peak in October 2007. That was the second and highest bubble. And just before that, housing peaked in early 2006. And just after that, in early to mid 2008, commodities peaked and fell. Oil fell from $147 to $32. That was the second and main bubble, and now we have the third bubble, what we call a bear market bubble. Now, we've never seen this before. We keep looking for a bear market bubble, to peak in 5 to 8 months. That's as long as is typical. This one's gone on now almost 20 months, and it looks like it's going to have months ahead of it. So the Fed's just creating the next bubble that's going to crash and kill investors again. For now, it looks like the wave up since September is going to peak by mid-November, perhaps as high as 1250 on the S&P 500. Then we're likely to see an overdue correction here. We're looking on our newsletter to issue a buy signal somewhere in late November, early December or so on this next correction. And then the markets look like they'll go up into at least late December and maybe as late as early March. So this does extend the rally. It does extend the targets. We see the NASDAQ likely going back to its October 2007 highs. The NASDAQ 100 or the QQQQs are already close to that. Now, that's not going to happen with the S&P and Dow, but the Dow could go up near 12,000, the S&P up near 1,300. So we do see this rally extending now, and investors short-term, if they desire, should get back in the markets on a correction. Now, we have a free report. If you'll go to meetharrydent.com and put in the code QE11, you can get this free report that covers more in depth what I'm talking about here and has a lot of charts to back it up. So we want to keep you informed. This is an unprecedented stimulus program, an unprecedented downturn with demographics and debt working together. You need to stay on top of this and protect yourself from the next crash, which we see likely coming between early to mid 2011 and late 2012. Thanks for listening.